Hello everyone, welcome to today's US Open live session. It is Tuesday, January the 23rd. I am your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. This is a packed week, and we already had the Bank of Japan announcing its latest monetary policy decision, and the European Central Bank follows on Thursday. And we also have key incoming earnings reports from EV leader Tesla and streaming giant Netflix, with Netflix just earlier around announcing its foray into live sports, a critical market with significant, with increasing importance lately. So these are some of the topics we will be covering today. Before we begin, please read carefully through the risk warnings and the disclaimers, and then we will go ahead. Once again, please read carefully through the risk warnings and the disclaimers, and then we will get started. And also, please bear in mind that anything discussed in this session does not constitute investment advice and should not be construed as such. Okay, let's get the ball rolling. We're gonna start today's session a little bit different with the US dollar versus the Japanese yen, and let's bring this in our screen. Why? Because we had earlier today the Bank of Japan decision. Then we're gonna talk about Euro USD and the recent repricing around expectations from both central banks, and then we're gonna talk about the Nasdaq, the tech-heavy index, which does not seem to find particularly from these tempered expectations around the Fed cuts. And then we're going to talk about what's ahead until our next session, which is mostly the European Central Bank and, of course, the latest earnings from Netflix and Tesla, who kick things off for big tech. Of course, if there are any comments on what we're discussing, or if there are any questions, please feel free to type them in the chat box. Okay, so USD/JPY has been rising again this year, as previously aggressive rate cut bets for the Fed and bets for an exit from negative rates by the Bank of Japan have moderated. Today, the Japanese central bank maintained its ultra-loose stance and slashed its inflation forecast, expecting CPI, ex-fresh food, at a median of 2.4% in fiscal 2024, which is the year starting this April, from 2.8% previously. This raises the bar for policy normalization by the BOJ, but at the same time, the bank appears more convinced that it will achieve price stability. Underlying inflation is expected to increase gradually towards this goal, while the likelihood of such outcome has continued to gradually rise according to the decision. Officials, after all, have already loosened their grip on the yield curve control and have pointed to an eventual end of the negative rates era. Inflation has been above the 2% target for 21 consecutive months as well. And of course, given the importance of wages, it would be reasonable for makers to wait at least until the annual spring wage negotiations. So, although the central bank maintained the dovish stance, there was, let's say, some preparation for an eventual change, but officials don't seem ready to take that step. So, given prospects of a pivot and the Fed repricing with CME's Fed Watch tool now placing the first cut in May, later than in March previously, the pairs has a mixed reaction and continues and sort of lacks firm direction over uh, over the last couple of days. It consolidates its gains. Now, there is scope for a test of the 200 period EMA, move lower, that is. It's the black line that you see on the chart around 145.70, although strong catalyst would be required for daily closes below it that would pose the upside bias. Above this 200 period EMA, bulls are in control and have the ability to push higher, although the next major resistance at 152.2, which is the highest level since 1990, may prove elusive in the near term. Let's turn over to Euro-USD. The pair continues to lack firm direction amidst murky policy outlook and ahead of Thursday's ECB policy decision, of which we will talk about a little bit later. Last week, we saw a pushback against aggressive rate cut expectations from both central banks. After the poor start to the week, the pair is in a precarious position, and you can see that it is losing ground today, around staying around the 38.2% Fibonacci. This keeps it exposed to 1.0722 support, but sustained weakness does not look that easy. And until that level, we also have the 200 days exponential moving average, the blue line on the chart, around 1.08. So it is a bit hard for the pair to find vigor at this stage, because ECB officials have pushed back against rate cuts, and they place them around the summer at best. Now, as long as the 38.2% Fibonacci is defended, the common currency can find renewed strength and try to reclaim 1.1 and eventually head towards 1.1144, although that is distant for now. Once again, if there are any comments, thoughts, or questions around what we discussed, we would like to hear them, so feel free to type them in the chat box. And with that said, let's turn over to the heavy Nash 100. It looks past this change in expectations around the Fed and actually clinched new record highs yesterday, which is largely due to tech and AI optimism, partly fueled by the recent strong guidance by TSMC, Taiwan's TSMC, which is the largest chip maker in the world. And of course, this week we have Netflix and Tesla kicking things off for big tech in the US. We will talk about them in a little bit in our What's Ahead segment. In terms of technicals, the next target is the 18K mark. Conditions remain overbought though, and with the Fed repricing the probably high bar for tech earnings, there is room for a pullback. However, strong catalyst would be needed for the 200 period EMA at around 16,600 for that tech level to be challenged. Okay, now let's turn into what's ahead and start with the European Central Bank. The central bank has started tightening its policy in July of the last year and has delivered 400 basis of 2022. Sorry, and has delivered 400 basis points uh, since of hikes since, and you can see here on the chart how it started in July 2022 and has and the deposit facility rate at 4%. Having made substantial progress towards price with inflation now below 3%, it believes that the terminal rate has likely been reached. It stood pat last month, as you can see on the chart, and is widely expected to do the same again on Thursday. However, officials are not ready to start lowering rates, with some seeing this starting in the summer, with markets more aggressive. So what we will be focusing on Thursday's decision is the language around future moves. And now let's turn to Netflix reports for the fourth quarter of the year, during which it reasserted its dominance and the stock was more than 60%. You can see here the highly lighted area is the 2023 performance. It returned to spot with the addition of 6.4 million so far during the first 9 months past year, totaling to 4.15 million users. And in fact, let's take a look at the subscriber numbers. So here is a comparison between major streamers. Netflix, which lost the top spot, Disney regained it in 2023 and has widened the difference. And you can see some other key players like Warner Bros. And Paramount, which are far below. Nearly 9 million users added in Q3, marking a more than 10% increase year over year. And the company expects similar numbers in Q4. Revenues, and let's turn to, you can see here the subscriber growth and the revenue growth as well as of the third quarter. Revenues rose 7.8% year over year, and the company forecasts further acceleration with double-digit growths. If it materializes, it will be the first time in 2 years to move to double-digit growth, as you can see also on the chart here. Of course, this performance, stock performance, and revenue and subscriber performance are largely attributed to two key initiatives: the ad-supported tier and the password sharing crackdown. On the other hand, this is still a highly competitive market. Disney appears to be making a comeback, while Amazon and Apple, I would say these two tech giants with deep pockets, are making strides. All of these companies also have live sports coverage, which I have been saying for many months now is probably going to be the next battleground. And I have said that Netflix needs to tap that market in order to fend off competition. And actually now it announced earlier today that it will enter live sports, as it will host the WWE Raw tournament starting next year, 2025. And now let's turn our attention to Tesla. You can see the technical analysis here on the chart. This is Netflix is due Thursday. Tesla is due on Wednesday, both after US markets close. The EV leader has a mixed year. On the other hand, broader EV demand slowed down and multiple race has caused a slump in profitability. And let's actually see that here. So you can see how operating and gross margins have been falling. On the other hand, its stock more than actually doubled in 2020. You can see that here on the chart. And the company managed to pick up pace in Q4 with record delivery and production levels. It remains to be seen, of course, if this can actually stop the narrowing margins if it can put a floor. Furthermore, the firm is updating its aging lineup with a refreshed Model 3 and the long-awaited Cybertruck, and there is also talk of a refreshed Model Y. Of course, given the current environment, high interest rates, high inflation, the big bet affordable mass-produced electric vehicle. Mr. Musk has essentially confirmed this, but has not provided much detail. So definitely we will be looking for any more commentary, anything more concrete. And of course, artificial intelligence and self-driving vehicles will also be in focus. So these are pretty much the main events until our next session on Thursday, as always 10 minutes before Wall Street opens. But there are other events as well, which include the Bank of Canada on Wednesday, which has not raised rates since July, New Zealand Q4 inflation, a series of preliminary PMIs from multiple regions, and the US GDP. So this is pretty much it from me for today. Thank you for joining me.